I want to thank everybody for joining us for this webinar this morning. I appreciate Anthony and Julie of the New York Real Estate Expo for hosting this event. I'm Mike Boggiano with LendingOne. I will be your moderator today. I'm very excited and honored to participate with this distinguished panel of multifamily lending experts. This webinar is a little unique in that we're going to get different perspectives across the country on what's going on in the different market segments. So without further ado, our panelists are as follows. Craig Hall. Craig is based in Atlanta. Craig Hall is an executive vice president of CBRE's Debt and Structured Finance Group, where he provides creative financing solutions for small to mid-market multifamily real estate assets. Craig is a top producer for CBRE's Freddie Mac and Fannie Mae small balance loan programs and leads a seasoned team with deep expertise in the Southeast. Since starting at CBRE, Craig and his team have funded over 300 transactions and have been Freddie Mac's SBL's highest volume team in the Southeast since 2017. Craig, can you tell me a little bit about CBRE and the products that they offer?
Thanks, Mike. Certainly appreciate LendingOne putting this together and the invitation. And all the folks that are participating remotely, I know we're all excited about at some point getting together in person. So I know I'm looking forward to that. Here at CBRE, right, we're a nationwide platform. My production partner, Ben Weddington, and I have a team here in Atlanta. There's 9 of us here. And our focus really is on multifamily in that small to mid-cap space, which for us is sort of the $2 to $15 million space. And again, our territory is generally in the Southeast, but we make these loans nationwide. For us, we do a lot of agency business. CBRE has been Freddie Mac's #1 lender for over a decade, and then specifically in the small balance space for the last 4 years. So, agency is definitely an area where we spend a lot of our time. From Freddie Mac's perspective, that small balance loan program really took off in 2013. It competes really well with the banks, particularly in the Southeast. That banks aren't quite as strong as maybe the West Coast or Northeast. Geoffrey is, but it's non-recourse money, it's 30-year AM, it's long fixed rates. One of the benefits that really resonates well here in the Southeast is that the banks here sometimes struggle with where the asset isn't in the footprint or the sponsor is not in the footprint, and obviously the agencies do a pretty good job with that. We do a fair amount of Fannie business as well, although in the smaller space right now, say below $6 million in proceeds. Fannie's a bit wide. The Freddie and Fannie are constantly battling each other, and so I suspect they will kind of even out here shortly. Areas where we do Fannie business would be maybe in smaller markets or lower leverage. That's where they have some advantage sometimes. Anything that needs some structure generally is easier to do with Fannie. Scattered sites is a good example. So that, again, we see a lot of agency business. We're seeing a lot more debt fund business recently as well. That seems to be something that's really gotten kind of hot lately. But again, we've got 9 folks here in Atlanta. All my underwriters are here, closers are here. Everybody's here to really provide kind of a good borrower experience, and that's kind of where we focus. Thanks.
Our next panelist is Edward Gray. Edward's based in Dallas. Edward Gray is a managing director at Greystone, where he focuses on the origination of multifamily loans in the central U.S. Mr. Gray has nearly 20 years of commercial real estate finance experience with positions in agency and bridge loan originations, evaluating debt opportunities, CMBS underwriting, and managing due diligence teams. He has held roles at CBRE, Citibank, Sabal Capital, and he has completed several $1 billion in transactions, including buying the first Freddie Mac K Series B piece. So can you give us a little bit of overview of Greystone and the products they also offer?
Sure. So I'm at Greystone. I'm based here in Texas. We're headquartered in New York. A little different. We're a family-owned business, not a little family-owned business, but we're a family-owned business. And so, it's one of the great points about us is when we have issues and we get the family involved and things get solved very quickly so our clients get the best result. Like CBRE, we do Fannie, Freddie, HUD, and we have our own CMBS program. We lend nationwide. very efficient, where we have, underwriters kind of throughout the nation so that they're underwriting deals localish to them. So they have more market knowledge. It's a great advantage. I'm very glad you have us here and looking forward to the conversation with everybody else.
Thank you. Our last panelist is Geoffrey Platt. Based in New York City, Jeff Platt is the Senior Vice President at Arbor. Geoffrey joined Arbor in 2010, is responsible for originating Fannie Mae, Freddie Mac, HUD, single-family portfolios, CMBS, and bridge loans. Geoffrey, can you just give us a brief overview of Arbor and of the products that they also offer in the marketplace?
Thank you, Mike, for hosting. I think you just gave an overview of what Arbor offers. But essentially, Arbor is a leader in the agency lending space. #1 SBL lender and Fannie small balance lender as well. Essentially, that is, I would say, our focus is on the agency space, Fannie and Freddie. We're also trying to get more robust on our HUD platform as well. We're also growing our CMBS footprint on a new private label product that we've established about a year or two ago. But that's about it. I mean, that's, I would say, is essentially our products that we offer. Like Craig had said, is that I guess the pendulum swings Fannie and Freddie, and essentially it's our role to kind of play to our clients' needs and kind of pitch which product is best for their needs, Fannie, Freddie, and the HUD products.
Let's get right into the meat of this webinar. Who are the current multifamily lenders for permanent finance and what is their niche? We've touched on agency lenders. So why don't we start with the small balance program, both for Fannie and Freddie. We'll start with Freddie. Geoffrey, can you just give an overview of the eligible property types and difference between the definition of affordable versus workforce?
So affordable properties are essentially properties that have an affordable component as a restriction. So that would mean a property that either has a HAP contract or a LURA, land use restrictive agreement. Workforce housing, according to Fannie, Freddie, or HUD, is essentially any property that provides affordable housing in terms of the rent affordability. So right now, Fannie, Freddie have a calculator that we all calculate the rents and we check to see if it qualifies based on the AMI, area median income. And it doesn't necessarily mean that a property has to have a land use restrictive agreement, a LURA, or a HAP contract, meaning an affordable property. But if the rents qualify, meaning that the rents are below a certain threshold of area median income, then it'll meet the mission, right? The mission that Fannie Mae and Freddie Mac have in the charter that qualifies for workforce housing. So it's a good thing for clients to be aware of if their rents qualify for this mission, that they actually are afforded a discount on some of their rates. So there's a distinction between affordable housing, right? Affordable or low-income housing, which has a HAP contract or a LURA, which is a deed restriction, which is a different type of loan product altogether. And then workforce housing, which is the mission-rich product. And that's market rate housing. It's just workforce housing in terms of that the rents meet a certain, AMI, area median income, meaning that your rents are low enough to qualify for quote unquote workforce housing.
Thanks for that distinction. And eligible property types, obviously it's multifamily, but is there, does mixed use also qualify?
Yeah, so basically, according to the agencies, multifamily means any property that's 5 units or greater. Now, you can qualify for mixed use, meaning if you have a commercial component, as long as the residential aspect is 5 units and greater. So you see that a lot in the Northeast, in New York City. You have a lot of properties in Manhattan specifically, or in the 5 boroughs, where you have 5 units or 10 units over a grocery store or a retail. So we can finance mixed use. Although over the past year, it's been a difficult struggle, especially with Freddie Mac and Fannie Mae, with properties having their retail closed. That's been an issue. Although now they're starting to loosen up and lighten up a little bit to allow us to count a lot of that commercial income. But getting back to your question, multifamily is considered 5 units, residential units and greater. And yes, we can finance mixed use where you have at least 5 residential units and greater and some commercial component as well.
A lot of people interchangeably will use like affordable and workforce housing in terminology, but there is a distinct difference there.
Correct.
Appreciate that. Craig, for loan sizes, what is minimum maximum for Freddie Mac? And does it differ on different regions in the country? Is there a tiering process?
Sure. So from a size perspective, Freddie Mac on their small balance platform kind of caps out at about 7.5 million. They try not to sort of cannibalize their SBL platform with their conventional platform. And so they try to draw a pretty hard line there. As far as how Freddie Mac ranks or rates their regions, they use top regions, which would be gateway markets like New York City, Boston, Chicago, LA, standard markets, Atlanta, Charlotte, Raleigh in the Southeast, for example, and then small markets and very small markets. And the reason they tier them that way is they're going to generally offer some pricing advantage in some of the, what I call better quality markets from their perspective anyway. And then also their underwriting tends to be a bit more conservative as the market gets smaller. So maybe leverage drops a little bit, underwriting, debt service coverage increases, that sort of thing.
It's a risk rating per market. The smaller the market, the more conservative they are, and the larger the market, the more aggressive they will be in terms of offering leverage
Sure.
and better price.
And I suspect they're looking at that based on the density of the renter population. So I get a lot of questions about what are the population requirements that would create a standard market versus a top market. And it's not really that simple. Their algorithm is proprietary, but it's generally based on the density of the renter population in those markets.
Fantastic, thank you.
Sure.
Edward, what are the features of the small balance Freddie Mac programs in terms of, is it a fixed rate? Is it hybrid? Do they offer IO?
Yeah, so it's pretty straightforward how Fannie and Freddie work. As Craig pointed out, which one to give the bottom. So it starts at $1 million on the small balance products and goes up to 6 on Fannie or 7.5 on Freddie. But yeah, it's a fixed rate product. 5, 7, or 10 years. Interest only is available. Generally 1 year on a 5-year, generally 2 years on a 7, and generally 3 years on a 10. Full term IO is available to lower LTV. And they do offer hybrid loans, which are 5, 7, or 10 years fixed, followed by a floating rate portion out to 20 years. Those loans are just fantastic for during a market dislocation like during COVID. The last thing you want to have is your loan coming due when the market's in a dislocation. So you can just float for a year or two and then refinance it when you're ready. Freddie waives the prepayment penalty during the floating rate period if you refinance with Freddie or if you sell it.
I think that was a couple of years ago. So you have to double check on the loan docs on that. I think they may have changed that, waiving the 1 point prepay during the floating. I think that was in the early loan docs for Freddie SBL. They may have changed that where they waive it if you refi with Freddie.
They've changed that. I may have made a few mistakes as a client. We will definitely be
I was letting clients know as well that up until like very recently, and then I checked with Freddie, and I think they may have mentioned to me that their loan docs have changed, that they may not be waiving that 1% prepay during floating. But I may be wrong, but I would double check with Freddie.
What is standard prepay in the Freddie Mac small balance programs? A decline in yield maintenance? Or?
The standard one is considered to be the declining, the 5.4321 or 5.54332211. For a lower rate, you can get yield maintenance, and there's also a weaker prepayment penalty. So you can structure your business plan to match your prepayment penalty.
Safe to say that the Freddie Mac has flexibility in prepayment options.
Correct. Fannie does as well. So they both offer that. So again, it kind of goes back when comparing the two. Right now, it's Freddie, pricing versus Fannie credit. Kind of which one do you want to work with?
We'll get into Fannie in a little bit, but these loans tend to be non-recourse, correct?
Yep, they're non-recourse, excluding the normal bad boy carve-outs.
Okay. We've been talking about rates a little bit. When do these loans rate lock? Are they commitment? Are they a term sheet? When do the rates lock?
Freddie locks the rate on an SBL at the signing of the term sheet. And so you don't have any interest rate risk during that period through closing. The only thing that drives people nuts is that sometimes Freddie does lower rates during the process, and you don't get the benefit of that. So it creates some stress sometimes, but it is fantastic. You have the rate certainty from day one.
And I guess, gentlemen, safe to assume rates still are historical lows in terms.
Yes.
Yes.
Across
Absolutely.
the board. All right. We've talked about the eligible properties and a little bit of the loan characteristics, but one question, Geoffrey, on sponsorship eligibility, typically what does a sponsor have to have in terms of financial wherewithal to qualify for a Freddie Mac small balance loan?
So small balance loans, typically it's relatively similar across Fannie Mae and Freddie Mac, but typically they want net worth of the sponsor to be equal to or greater than the loan amount. They want liquidity to be equal to or greater than 12 months of principal and interest on the loan. They want credit score to be equal to 680 or greater. And Fannie Mae, this is where it gets a little bit interesting, is that Fannie Mae typically wants at least 2 years of multifamily experience, and Freddie Mac, and again, this is where they're getting a little bit more strict, and guys, correct me if I'm wrong, that they want, in terms of the experience, they want to see, I think it's ownership, not experience on multifamily in order to qualify. They want like 2 multifamily properties owned for 5 years or 5 multifamily properties owned for at least 2 years. And they like don't waver from that. And if you don't have that, then you need to bring on another sponsor who has that experience. Furthermore, if you're non-local, then you need to if you're non-local, then you need to have third-party professional management, and being local means living within 100 miles of the property. That's at least in terms of Fannie Mae guide. I'm trying to think, and that's the qualifications of a sponsor for both Fannie, Freddie. That's kind of a general overview.
Do they also lend to foreign nationals, or do you have to be a domestic borrower? So
Fannie Mae is pretty clear that it has to be a U.S. national. They do offer waivers, but currently Fannie Mae is not really entertaining waivers on loans lower than $3 million. They may be easing on that soon, but I think currently they're not entertaining any waivers below $3 million.
The experience requirements, particularly the ones that Freddie Mac has, are relatively new. Those kind of came about last year, kind of post-COVID, or kind of right in the middle of COVID. And what they are specifically is that they want to see ownership, like GP ownership, control of at least 3 properties, 1 for 2 years, or 1 property for at least 5 years. But what we found is that they're actually pretty comfortable with sponsors that don't meet that necessarily, but certainly pass the eyeball test, right? So we have lots of conversations with Freddie Mac on a daily basis about trying to compromise to say, well, this individual owns 5 properties, but maybe doesn't own them for as long, or they've got great management, or they're local, or whatever the advantage might be, the mitigant. And so we found Freddie Mac to be flexible there. They may want us to mitigate it with some leverage, or maybe some higher debt service coverage, but generally speaking, they've been really cooperative there.
It depends. It depends on, like we were discussing earlier before the webinar went live, it depends, I think, on the market. Like you said, Craig, if you're in a tertiary or secondary market, where the assets are located. That usually will tell us kind of where Freddie's comfort level is. Like you'd mentioned, if the borrower is local, but I've had, some luck and not such great luck on getting Freddie, to kind of ease up on that restriction. So it all depends. And that's kind of where, I've been able to kind of balance the Fannie versus Freddie and guiding people kind of, where I think is the best execution in terms of that, where I can navigate, Fannie Mae being very clear that, you just need 2 years of experience. And if you're local or non-local, you need a third-party management company. It's very clear what they need and not kind of a hazy guidance of whether it's 2 years of 5 properties or 5 properties and 3, it's very kind of, so those are the pros and cons of the Fannie versus the Freddie product. But you're right. I mean, granted, there is a relationship with Freddie Mac and there is some kind of wiggle room in terms of, what can be approved and what can't be. But like we were discussing earlier, there is a kind of a move towards the secondary, tertiary market that I'm noticing as well outside of, and I think maybe Mike will get to this eventually, about moving away from the primary markets of, Northeast and moving kind of towards the Southeast and the Midwest as well,
Yeah. That's a good segue to get into the discussion. We have agents, we consider, agency lenders, and Freddie Mac is one of them. And then we also have the sister company, Fannie Mae. So when we just delve into, the Fannie Mae small balance programs and, an overview of it and, how it differs from the Freddie Mac small SBL program. Edward, in your experience, eligible property types and loan sizes, I mean, I think we touched briefly on the loan sizes, but property types, are they the same as the Freddie Mac program?
Property types are basically the same, 5+ units. You can still get some mixed use through. Fannie's less attractive on the mixed use, 1 to 6 million. We recently closed a deal in South Texas where it's a portfolio. We took 1 Freddie SBL and 1 Fannie small for the same borrower at the same time. It just, that's where, having both tools like we all have, Fannie and Freddie, you just look at both and figure out which one's the right one that day.
So I think that you bring up a good point, Edward, is that all of these 3 lenders here have access to both the Fannie, Freddie, and then also HUD programs. I know that there's SBL lenders that have one program or the other, but not both. So if it doesn't fit one program, then you have to go out and find another lender. But having the flexibility to switch back and forth between Freddie and Fannie is an advantage that you 3 have in the marketplace.
Yeah. And Freddie actually just emailed me back. They currently, still offer the 1% waiver during the hybrid period of the loan.
Forward me that email, because that's not what they told me when they came to our office a couple of months, last year. So forward me that email.
To you. It says if the language is missing, please reach out. I literally just got the email.
All right. So
times are changing. All right, cool. That's good.
That's good to know.
So, okay. So then let's talk about markets, because I think that's probably the biggest difference between Freddie and Fannie, the markets that they serve. And I'm going to make this an open discussion. I mean, does Fannie have more of an appetite for the tertiary and secondary markets than Freddie, or how do they view those markets?
I would say that they do, because like Craig had mentioned earlier, that Freddie Mac segments the market into top, standard, small, and very small. And when you get into the small and very small markets, Freddie Mac limits you and caps your leverage and the coverage, and it also restricts your rate. Not restricts it, but puts a higher rate on those deals. So in essence, it does limit kind of where they want deals to be financed in terms of the market. Whereas Fannie Mae doesn't work like that. They see the market as a national market, and then they have pre-review markets, where specific markets where they will limit leverage and coverage. So when you're talking about, do they have specific markets that they want to be in or not want to be in, or which lender in terms of Fannie and Freddie are more pro secondary and tertiary markets, I would have to say hands down, Fannie Mae is I wouldn't say hands down, but I would say that Fannie Mae is more, you can get more leverage easier in secondary, tertiary markets than I would say Freddie Mac. But it all depends. I mean, you have to look at each deal on its own 2 feet just to kind of size it. And that's what I think you had mentioned before. All 3 of us have access to both products. So when a deal does come in a secondary, tertiary market, you do size it both ways and see which deal yields the best execution for the client. So that's, I mean, I would say Fannie Mae for secondary, tertiary markets.
And then with Fannie, I mean, are the features the same in terms of, you know, the hybrid program, the interest only? I believe not, it's non-recourse, but is there any differentiation between the features of their program versus Freddie in terms of hybrid, interest only, things of that nature?
They're generally about the same, Mike. I mean, there's some nuances as it relates to, you know, some have different refinance tests or, interest rate stress tests or minimum debt yields and things and how they size the deals. But generally speaking, the structures are very similar in the small balance space, as well as when you get up to the, you know, the middle market space and you know, and more traditional conventional ones as well.
And then sponsor eligibility, we touched on that briefly before for the experience, net worth and liquidity, and the domestic versus foreign borrowers. Anybody want to add to that previous discussion? Or
I think Freddie's a bit more flexible on the foreign nationals.
Yeah.
So that's probably maybe a little advantage there. Your pricing right now for Freddie Mac is significantly better than Fannie, so there's an opportunity there. They're tinkering, right? So when COVID struck, right, the agencies were getting more calls for forbearance than they were for new loans, and so they had to find a way to do business through the crisis, the pandemic. And one of the big ones was a debt service reserve. So that's been a real struggle for investors, having to put up you know, as much as a year or even 18 months sometimes with Fannie of principal and interest payments. But that pendulum has swung back significantly. Even yesterday, Freddie Mac came out with some revisions to their reserve requirements that are they're about half of what they were the day before. So huge positives there. You know, again, as difficult as it's been for all of us to operate, you know, in this environment, I think we're all blessed to be in this environment, right? Where we got good markets, multifamily has been super active. The rates have been great. You know, our conversations before this were just about, you know, generally what's going on in our markets and how busy everybody is. And I think that's a testament to just being in this kind of B and C multifamily space, which I think has got a lot of legs.
Now, my next question, and I think we already answered this, so I was going to say, why choose one over the other, Freddie versus Fannie? I think if there's anybody listening to this and you have a multifamily transaction, the best course of action is to give one of the 3 of you guys a call so you can determine the best fit for it. And then also, if you're a mortgage broker, you can't go directly to Fannie or Freddie. You have to go through a delegated lender such as yourselves to be able to get financing. So my recommendation is, if you're going to choose if you're on the fence and choosing either Fannie or Freddie as a broker or as a borrower, give one of the 3 of you a call and let you guys decide what is the best fit, as opposed to going to a shop that only has a Fannie small balance or a Freddie. You guys will choose the best program for the borrower that's available to them.
We present both every time. I mean, that's really the best way to do it.
Yeah, we're actually taking in some CMBS quotes right now as well. You know, we're working on a deal, you know, tertiary Houston, you know, far outside of town, where it ended up making more sense to take it CMBS than Fannie or Freddie. So I mean, you know, we're able to use all of our tools in the bucket to make sure that, you know, the borrower gets the best option possible.
We talked about the small balance, and then we talk about their conventional program, and I guess it starts at where they cut off on the maximum loan amounts. And then is there a maximum loan amount for either Fannie or Freddie, or how does it differentiate between the small balance?
I frankly would love to find the maximum loan amount. Has not been my problem yet. I keep looking for it though. One day I'll try and find a loan that's the max amount.
I think they have caps because I think it was earlier in the year there was a shop that did.
Mike, are you talking about on the conventional or on the small balance? Because the small balance.
Conventional.
Oh, on the conventional, yeah. Yeah, I guess Ed's right. We'll try to find that one day.
Well, they do have, and maybe what you're talking about, Michael, is the agencies are capped in the amount of volume that they can do on an annualized basis, and that's been a big news lately, right? So their caps were adjusted down just slightly, for this year, and those caps are basically a function of how large the FMHA wants the agencies to participate, right? They don't want the agents to be 98% of all the loan volume, right? They try to limit them, so they measure the size of the market and then limit the agencies to participate at some level they feel comfortable with. Let's say it's 35 or 40%. I don't know that number. And so what they've also done recently, which is, we've seen some impact on, and I think we'll see impact certainly later in the year, is they've created a mandate where they need to do a certain percentage of their business to be what Geoffrey was talking about earlier, which is mission-driven business. And what we call that is capital A affordable is deed restricted, and then lowercase a affordable is really more kind of naturally affordable. Teachers, firemen, service worker types of tenants. And I think that's really where the agencies, workforce housing, and that's really where the agencies want to play. And so from our perspective, and probably, not to speak for Edward and Geoffrey, but in this B and C space, a lot of what we do is mission driven. And so it's welcomed, right? Because that's really what they're trying to do and help solve this affordable housing crisis. So I don't know if that was your question or not, but on the small balance side, we don't move the needle quite as much, right? $3, $4, $5, $6 million loans are not moving the needle and impacted as much as, let's say, the 50 or 60 or $70 million loans that they might do in the conventional space. So we're constantly at CBRE watching those volume targets and advising our clients that, hey, look, the window may be closing soon, so we kind of need to act quickly. But as of now, they're running a little hot, but we'll see what happens later in the year as far as availability goes.
Yeah, I mean, Craig hit the nail on the head. It's a much more serious answer than mine about trying to find the biggest loan we can do. But if you think back to, the fall of 2019, when we ran into an issue about, Fannie and Freddie hitting their caps, and it's like having to tell people, we're kind of done for the year, see you in January. Like, that was not a pleasant thing to start telling people.
But the good thing is that, Arbor was able to, at that time is when Arbor came out with our private label CMBS product. And actually our CEO, Ivan came out with that product specifically to meet that need in the event that happens again. And also we came out with that product to meet the need of what you had mentioned before, Mike, the pre-review markets for Fannie Mae and those small and very small markets for Freddie Mac. Our CMBS, our private label Arbor CMBS product does not have those restrictions. So, and also, in the beginning of this year, when Fannie Mae, kind of what Craig had mentioned, Fannie Mae was kind of stepping out of the market a little bit because their spreads widened considerably and they weren't pulling back on the COVID reserves and things of that nature. Our private label product was able to step up and fill that need. So there are a lot of different products, and I think Ed can also attest to that as well because he has a similar product. That there are other products out there besides the agencies that a lot of us have that can fill those needs. But I can say myself that my CMBS product was able to fill that need where in 2019, when essentially Fannie Mae shut the pipeline, we were able to open up our CMBS and fill that need that people had to finance their products. Our CMBS product is very competitive with the agencies. We don't have a COVID reserve, and our pricing is very attractive. And essentially, it's very similar in terms of the structure of an agency product.
Jeff, you bring up a good point there, because there are other lenders in the marketplace providing financing outside of the agencies. Primarily the ones that come to mind to me are the banks, life companies, CMBS. And Craig, you mentioned this earlier, that we have, private lenders or debt funds that are getting involved in the space as well. I mean, what are the benefits of, for example, a bank over the agency? Why would you take a client to a bank versus taking them to the agency today?
Sure. Well, I guess there's a couple of reasons. In some instances, you have investors that are sort of yield-driven investors, right? Where they want long AMs, cash flow, because they're trying to generate yield on their investment. Those are generally great for the agencies and CMBS if that's kind of the last option. And then you got lenders or investors that really just want to pay down debt as fast as they can. They're not really after cash flow. They want to plow every dollar that they get sort of back into equity. And so banks are a great spot for that, because generally the bank's going to have lower AM options or even require a lower amortization to pay the debt down faster. Other areas where banks are great is for your first deal, right? If you've never had a multifamily apartment or been in the commercial space and you're trying to get your first deal done, the banks are a great option there, because on the agency side, on the CMBS side, the non-recourse side, all we're underwriting is that specific asset and that sponsor's ability to execute the plan. On the bank, it's a full recourse, generally speaking, at least in the Southeast, it's a full recourse environment. And so if you're a stockbroker and you're making $400,000 a year, and you've done that for year over year over year, and you're going to get this gentleman's personal guarantee, if he's going to buy a 10-unit property and it's his first one, that probably doesn't work out, no big deal, because he's got tons of money coming in from other sources. And so the banks can kind of look at that as at a global environment, where the agencies and CMBS really look at it, specifically. So those are two areas that I would think that would be best fits for the bank. I guess maybe the third area would be, you've got an unstable asset, right? And there's a construction component involved in it, right? So you're going to acquire the asset, and then you're going to need $10,000 a unit to upgrade the units, improve the rents, transform it. So, a bank would be a good option there, or certainly a debt fund like LendingOne or LendingOne, and all the debt funds that are out there, that are doing that type of business.
Read this morning there was an article where the private lenders and debt funds now are competing against the agencies in terms of offering greater leverage, and then their spreads have come in as well. Are you seeing more of the debt funds and private lenders coming into the space, competing directly against the agencies and the other capital providers?
Absolutely.
I mean, we see that every day. It's, the debt funds are just able to be so much more aggressive right now. I was literally making those phone calls yesterday for a client. And, when you're having someone tell you that they're going on essentially a bridge loan down to LIBOR 250, it's just kind of amazing to me that, they're able to get there and they're willing to lend the money.
Yeah, and what's creating that leverage is where the underwriting requirements of the agencies are looking at it on an amortized basis on in-place rents. The debt funds are not necessarily looking at that way. They're looking at the cash flow on an IO basis, or frankly just what the exit's going to be, right? And so the focus really then is driven on the sponsor's plan, their experience, and how that specific property is positioned in the market. So they're able to lend on kind of the future promise of what this property is expected to do, versus the agencies kind of looking back to how the property has performed in recent months.
Craig, I think you just gave the pure definition of the My Loan program here at LendingOne, because we provide financing on an interest-only basis, and we look to what the exits is going to be. And normally it's to one of the agencies going through you guys for refinancing, but we're able to offer greater leverage because it is on an IO basis. And do you guys, all three of you, have access to, to various capital providers, the banks, the life companies, CMBS, and then private lenders as well?
Absolutely.
Yes.
Fantastic. So another reason why any of our listeners in the audience should be in contact with you guys. All right. As a general discussion, what are you guys seeing? I mean, you guys are all sitting in different parts of the country. Any specific trends you see in terms of like refinancing or acquisitions or new builds?
Yeah, I mean, we're seeing some pretty cool stuff in the central portion of the country. I mean, people are very active. We're definitely, sizing a loan just yesterday for a California investor coming into Texas for the first time. We're still seeing, people coming here for, I don't want to call it chasing yield, but, buying advantageous deals here. It's still great buys. I feel like, it's comical. I live in Houston, Texas, one of the fourth largest city in the nation, and it feels almost undiscovered sometimes to outside investors. There's lots of great things still happening in the market.
Southeast is similar, right? There's even sort of, pre-pandemic, there's been in-migration from a population perspective. So rents have been fantastic in the Southeast. Yields traditionally have been a bit better than gateway cities, kind of like Edward was saying, with the Southeast or the kind of the Mid-South and Midwest. And then you mentioned refinancing versus as acquisitions. And we all might be a little bit different here, but from my perspective, we've been fairly balanced. In the last couple of years, some big refinance portfolios have sort of tipped the scales a bit. Certainly seeing some refinance activity now because the rates are so low, and the low rates are contributing to two things. One, obviously interest rate savings, but the lower rates are also contributing to lower cap rates, right? Which is creating value increase, which is providing equity, additional equity and cash out to these investors that really have owned these properties for a relatively short amount of time. So, the Southeast has been a strong market, for a while.
Yeah, I feel like we've seen a lot more refinances lately, but there's not as many properties available in the acquisition market. And so when they do become available, like, Craig said, there's a feeding frenzy, which pushes the value up, which in turn pushes the value up of the refinance property. I feel like that's been the biggest issue we've felt as far as people saying acquisitions, is that the sellers don't necessarily have the replacement property to buy when they sell. And so I feel like for us, we've seen a lot more refinance business lately than acquisition, just because there haven't been as much transactional volume on the sales side as we would hope.
Right. In the cash that you take out in a refinance, right? You don't have the tax pressure to exchange into something else. So we have that conversation quite a bit as well.
Geoffrey, what do you see? I mean, you're in ground zero of the pandemic, New York City.
Yeah. So I would say is that, obviously everyone's aware that New York took a pretty big hit over the past year in terms of rental income and just rents and commercial income with stores and retail being closed. I would say probably in the past 2 weeks, rents have increased significantly. There was a large inventory of rental units on the market for months. People couldn't rent their units. And like I said, in the past 2 weeks, everything's been absorbed. A lot has, and rental prices are on the rise. Like Ed had said, majority of the stuff that I've been doing are refis. It's interesting, a lot of the stuff that I'm doing in the Northeast, I do lend nationally, but a lot of stuff that I had been doing in the Northeast has been refi cash outs on deals that have been bought over the last year or two and have been renovated and refi, raising rents and major renovations. Mostly New Jersey, not so much Manhattan and the 5 boroughs, because it's sad. It's just that the politics in New York City, unfortunately, fortunately, unfortunately, I don't want to get into that conversation, but I had a deal where I financed it for somebody, for a client of mine a couple of years ago, and rents have remained relatively flat over the last 5 years because of rent stabilization and rent control laws. There is not that much growth in terms of rent because of the laws, and the laws aren't favoring, you know, landlords and owners really in New York City specifically. So a lot of the deals that I can do on Fannie Freddie, because of the way that the underwriting is structured, is mostly outside of New York City specifically. So a lot of stuff that I see is New Jersey, New Jersey, Newark area, Irvington area, Connecticut, things of that nature around New York City. And I would say the most competition I see in Manhattan is from the banks, because the banks don't have those restrictions that I have on my underwriting. They're able to kind of dig in on the underwriting. And the deal that I had that I was looking for a client on the refi, where it was literally a cash-in deal. It was a cash-in deal when I was sizing it. And I mean, obviously, if I were in the client's shoes, I wouldn't refi cash in on an agency deal. And he went to a bank where he has a relationship. And that's where I was going to touch upon before. The local banks in these regions, it makes sense when the bank is local and the bank knows the market. And that's when they can dig in and be creative. I mean, obviously, I'm not a bank, and they put it on their balance sheet. So they know the risk involved with that local market, and they know the asset. But granted, in this specific case that I was talking about, rent stabilization, rent control, and it's not just New York. I mean, it's in different cities, Pacific Northwest and the West Coast. I mean, you know, it's tough. I mean, taxes going up, utility bills going up, and rents remaining flat. It's very difficult for some owner operators. So that's what's going on in New York. But on the positive note, rents are going up in New York for non-stabilized, non-controlled units. So there are some positive things on the horizon in New York City in the Northeast, and yeah, I mean that's basically it.
Bring up a good point there, Joe. I mean, what are the more challenging deals to get done in this marketplace, or property types? Student housing, assisted living, construction.
So student housing and seniors have been, I mean, you guys can correct me if I'm wrong. I mean, those were basically on a no-fly zone list or no-go list with the agencies for like the past year. They're starting to, I'm getting rumblings that they're starting to be okay to look at them on a case-by-case, you know, yeah, I mean, they're starting to look at them. But like student housing for sure was no-go, and seniors was no-go for the last year. But they're starting to open up.
I suspect that improves dramatically. You know, I've got a kid going off to college this year, and you know, it's a waiting list to get into the dorms, and you know, the demographics as it relates to seniors housing is super supportive of that.
It has to open up. It has to. They have to open up.
Problem.
Yeah. Yeah. I mean, on both seniors and student, there's a big split in ownership. You know, for institutional ownership, they still get institutional deals done. I'm not saying with no issue, but institutional deals still get done. But when you switch to senior or student at the private client level, you know, those deals are much more difficult to get done. You know, we pitched a football school student housing refinance for a family that owned the property for 20 years. It was their only student housing asset, never mind that they owned multiple deals in market. And that one was a very difficult deal to get a quote on, period. And we were only able to get a quote at, you know, 55% at a 155 cover. You know, I mean, there's a huge difference between, you know, bringing in a gigantic student operator and the private client borrower. You know, there's a disconnect still there. And it's, you know, I assume over time that they will come back to being closer together. But right now that, you know, the private client student housing operator is in a difficult spot. You know, we passed on a deal in the last 2 weeks, again, for a private client student housing operator, been in market for, you know, 20 years, but we couldn't get the leverage that they needed. So that's probably going to a bank.
But see, that's the challenge. What I was mentioning earlier is that a local bank knows the market. And sometimes the challenge that we all face with Fannie and Freddie is that they think on a national scale, and have their blinders on and they think student housing, okay, no, I won't touch it unless it's that, 55. I got the same issue. I had a guy who owned a deal, I think it was in near Penn, not near Penn, near, well, wherever it was his only family, it was only a property there, family owned for like 20 years. I got the same story. We'll only do it at like 50 something leverage. But they didn't understand that this property had full occupancy and no issues, and they just weren't willing to talk at all. But a bank knows the asset, knows the market, and they're willing to budge a little bit. But look, let's see what happens in the next couple of months, and we'll see if they open up again.
I think we have time for one more topic of discussion. It's going to be brief because we're coming up on our time limit. We talk about ground up construction. Is HUD basically the only game in town right now in terms of providing finance? And I mean, it's very attractive. I'll let you guys chime in on that.
No, I mean, I love the HUD 221B4 product. I mean, it's a fantastic loan, but right now they're so backed up that if you submit a deal to HUD, it's not going to get picked up at HUD until September, possibly October. So, I mean, I would feel right now that conventional bank financing, while not as attractive, is probably the better play for a lot of people who need to get their property out of the ground.
I think it all depends on what type of construction project that the client is looking for. Arbor has an SFR construction product that we can offer for single family, but it all depends. It's a custom. It's a product that I can customize. So it depends if you're looking to go ground up or if you're looking to go horizontal. So definitely we can entertain something on that side. But in terms of the ground up, it's unique. I mean, people are definitely doing construction projects. The HUD, like Ed said, is backed up. I mean, if you have the patience. A lot of people who've come to me for construction are looking to do it quickly. So they don't have that patience. And like you said, Ed, they go to a bank. Arbor does have a ground up construction program, but typically it's 25 million and plus. And so it depends on what the client's project size is. And usually you have to kind of fit into a certain box, or not a box, but in terms of the requirements to meet the program are kind of strict, but we do have programs for that, but typically it goes to a bank.
On that point, one of the great things that's happened recently is HUD no longer has a 3 years post certificate of occupancy rule. They waived that last year. Yeah. And so you can bring a deal in for, rather than the 221D4, the construction loan, for the refinance, 223F. And right now the rate on 223F is 239 plus the MIP. I mean, I don't want to call that money free, but I'm willing to borrow a lot of money at 2.39%.
That's true.
And so
on the construction
build
loan.
up your bank and bring
on the refi after construction. Yeah.
Gotcha.
Because HUD used to have a 3-year waiting period rule where after you did construction through a bank, not through HUD, you'd have to wait 3 years before you could do a refi. They got rid of that rule. So that's what he's talking about. But you're essentially, I'd have to wait a year because they're backed up. So the whole process takes 12 months. So it's essentially a 1-year waiting period.
That's the one knock I always hear about HUD is just the timeline to be approved.
But it all depends on the lender you're working with, and the lender will hold your hand through the process. It's not an easy process, but if you have a lender that you're working with that can help you navigate the process, that's what really matters.
You touched on briefly, we're become a new asset class in what I view as multifamily. It's a single family rental, where you've seen it become more of like an institutional asset than traditionally that it's been, mom and pop operators. I mean, they still control the mom and pops, the vast majority of the market, but we're seeing more and more institutional owners come into the market, not only owning the properties, but also what we just mentioned, build to rent properties as well. So that's an interesting development over the last, let's call it 3 to 7 years, but we've seen more of it in the last 12 months than we've seen previously.
Yeah, I mean, SFR feels like it's about the trendiest product in real estate right now. If you can get that going, that's like what everyone's looking for. and it ties in so well to COVID. I mean, who doesn't want to have a house, you know, little yard rather than being an apartment? I mean, it's the on-trend product if you can get it going.
Which is a bit ironic because, you know, we think about obviously most of the clients that we work with at some point in their career, they graduated from single family right into multifamily, and now the market is shifting back. I think it was Freddie Mac a few years back piloted an SFR platform, and CBRE built a business around that. Unfortunately, Freddie wasn't able to continue that pilot. But through that, we developed a lot of relationships with folks that lend on that type of space. I think as much as the investors are coming in, there's also a lot of debt opportunities. Mike, I know you guys do quite a bit of that as well. So,
Geoffrey, I think you guys were part of that program initially too, way back in the day, correct?
Yeah, we were, I think, part of the pilot program on the Freddie SFR space, which kind of phased out. So we actually built out our own SFR perm loan product, which we're a leader in the space as well. We also have a construction product on the SFR. And that product is gaining a lot of momentum now. And like I mentioned earlier, that the spreads on that product have tightened considerably. So it's getting, a lot of my pipeline is based on the SFR, loans, and it's definitely a lot of stuff that I'm seeing right now for my clients.
That puts us at the hour. I want to thank you, gentlemen, for participating in this webinar. I also want to thank the participants for taking an hour out of the day today to join us in our discussion. We have a few questions, but we're gonna answer them offline because they're deal specific, and I'll forward them on to I'll forward them on to all three of the panelists for them to respond back to the investors or to the brokers. Okay, and gentlemen, thank you again.
Thank you, Mike.
Thanks, Mike.
Thanks everybody.
Thank you. Take care.